Hello and welcome to today's episode of Nucleus Investment Insights. The question we pose today is, does the bear market have more teeth? Is now the time to buy, or does the market have further to fall? That's what we're going to discuss, and that's a question on many investors' minds. On the agenda, we'll do a broad market overview of stocks and bonds and the effect that global tightening is having on markets. Then we'll do a health check of the major markets around the world. First, we'll have a look at the European economy and the effects of the war and energy. Next, we'll look at how China's handling COVID and their property bust. Our world tour wouldn't be complete without seeing how the US economy is shaping up and the impact of the actions of the Fed. Then, as always, we'll explore the investment implications for markets at the end. My name's Sam Kerr. I'm the Senior Financial Advisor at Nucleus Wealth. Today, as always, I want to welcome the founder and Chief Investment Officer at Nucleus Wealth, Damien Klassen. Damo, thanks for putting on this great show, as always.
Thanks, Sam.
And today we're also joined by our Chief Strategist and prolific author and commentator, David Llewellyn-Smith. Dave, thanks for coming along also.
Thanks, Sam. Thanks for having me.
Just a quick reminder before we get started, if you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, you can follow us on your preferred podcast platform. Our show's available on all the majors. And just an FYI, if you'd like to look at the slides in a bit more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So now we've got that housekeeping out of the way, we'll get started. So Damien, I'll hand it over to you to lead us away.
Yeah, sure. So, as you said, we just want to do a little bit of a run through about what's been going on in the markets first, because it's obviously we've seen some massive moves in this month after and I guess we had some similarly poor ones earlier on, and then flip back to then a couple of all right months in between. So we'll start with the treasuries, and this is a US 10-year treasury. So basically, just a chart from Deutsche showing that it's the worst since basically ever. There was one bad month in 1788, which I think 1787 was it? Right. Okay. There's yeah. So yes, that's right. So anyway, yes, so a bad quarter for treasuries. Yeah, that's right. It's just the ship wasn't there yet. That's hadn't reached. Then you're looking at the next one, the US equities. Sorry, and so that's and again we're just talking it's the first half of the year, and you can see the falls there are haven't been as low as this since 1932. So again, a massive drop in terms of. Having said that, though, this is talking about it's a little bit arbitrary in terms of talking about from the start of the year. There's obviously periods where the US markets performed worse, but this is more just talking about a calendar year type thing. And then finally, just sort of showing from the market perspective that's basically similar to what you would ordinarily see in a recession. So if you looked at all the different recessions sort of post World War II, this would sort of sit about average if you were having a recession. And so I guess our thoughts that yes, we are headed for a recession sort of shows you're halfway there, and then the question is do you get further downside because markets were pumped up so much higher at the start in terms of valuations, and so your valuations have to fall back to more normal levels first before you even get your earnings come through. And then the final sort of one on those markets before we sort of get into valuations, I just wanted to bring up was the liquidity side. And there's a number of ones out there just showing that the markets have still had some pretty good inflows. So what this chart I've got up there is just showing the amount of new money coming into equities. So basically from investors sticking new money into the market, and we can see from the start of January 2022, it's added not quite 1.5%, so sort of 1.25% more funds to the market. And if you look at any other equity correction, usually you've got money going out the door. So, I guess the message is, investors over the last couple of months have still been putting money in, which has actually been holding markets up even more than what they would have done if those sort of retail investors weren't there. And when you dig into that, it is very much retail investors. The institutional investors are sort of been pulling money out, and it's largely been a retail a retail thing. And so I guess the question there is how much longer that can go on for, and if that support is removed and potentially even goes the other way, if sentiment flips and people start withdrawing money from the market, does that actually bode for further downside? Dave, any thoughts on those ones before?
On this latest one, I guess the main point to make is we analysts are always looking for evidence of capitulation during bear markets, and that chart tells you there's absolutely none to date. I can't remember any bear market ending with still wildly positive inflows of money.
Yeah.
So, well, that's a bit of a red flag, and the other stuff is what it is, I guess.
Do you think that's just the people that are conditioned to just buy the dip always? Do you think some people just think, oh, it's just another sort of sell off, it's buy the dip? You think that's what's playing out there?
Well, I guess it's that, and the Fed's only just started QT as well, so there's still lots of liquidity in the system.
So what QT, David, what he's talking about is quantitative tightening. So basically, the Fed's been up until last month, they were still actually putting more money into the system. They were still buying US bonds, whereas now they've actually stopped buying, and the US is still issuing. So that's starting to draw a little bit of money out of the system.
Yeah. So, and yes, we have been very conditioned over the last decade of low interest rates to buy the F and dip. So maybe that accounts for it to some extent. Just if you do see it as a part of a larger picture of recession or etc., then you certainly wouldn't expect to be bottoming out with strong inflows into equities.
And you've certainly had over the last whatever it is since the financial crisis or even before that actually, this thought that when so back to 2000 even, this thought that when things go wrong in the market, then the Fed will step in and support prices, whereas the Fed's actually sort of explicitly.
But even on the occasions it did that in 2015 and then 2018, when the market had fallen, I don't know what, probably 15, nearly 20% on both occasions, the flow of funds into equities were negative, deeply negative.
Yes.
On both those occasions. So this one's definitely atypical at this stage.
Yeah. So jumping then to valuations. This is the same chart we've shown a few times that we really went through this. They've sort of had two elevated periods in the last 20 years of valuations. First was that whole tech boom where we sort of US S&P valuation sort of got up to the 20 to 24, and then the post-COVID where it got to the same amount. From there, they fell back down to sort of 16 times over the course of a year or two before sort of eventually fading down into the sort of low teens, and we've sort of hit that first phase at the moment in terms of the US. So the real bubbly stuff has come out, and look, it's cheap. The market's cheaper now than what it was pretty much any time from 2015 onwards. But that was that period from 2015 onwards, while it was relatively weak growth, there was still growth, and very much you're looking at growth coming in from falling interest rates still over that time frame to support markets, whereas we've got something quite different at the moment. So that's the valuation side. The key one though is obviously this idea of analyst revisions. Now I've pulled a chart in that sort of compares the S&P 500 earnings versus one of the US, the Philly Fed indexes, which is just an index of trying to look at what future conditions are going to be like in terms of earnings, and you can see there's sort of a relatively good match between the two, where when one rises, the other one rises.
It's a remarkable correlation.
Yeah, but then you get to the where we are now, and you can see that the Philly Fed measure has just cratered. So it's sort of sitting at all-time lows, whereas the earnings from stocks is actually still pretty high, and it's still well above zero. So,
and Damien, do you mind just explaining to the viewers what the Philly Fed is?
yeah, it's a survey of companies and businesses about what they're expecting. And there's leading and lagging parts. So some of them are talking about what's happened in the past, and some of them are talking about what do you think is going to happen in the future.
And it's a manufacturing PMI, isn't
it? Yeah, I believe so.
Which makes you wonder, like, why there's such a powerful correlation between US manufacturing PMIs and earnings. I mean, I know they've still got considerable industrial base there, much better, like it's almost 3 times the size of ours in relative terms to the rest of the economy, but still,
yeah,
interesting correlation with something that's such a partial indicator of overall activity.
Yeah, but I guess I'd say that that's the most that's some of the most cyclical part of the economy. Like there's other parts of the economy that are a lot of the services sector that sort of just goes through sort of very small ups and downs, whereas the manufacturing does tend to do those big swings. So yeah. But and this is
that's where you see your inventory cycles as well that really heavily impact growth and earnings. So.
Yeah, absolutely. And so so this is just one example. There's a half dozen other similar types of things, that look at interest rates and housing markets and all these other factors that sort of give a very similar picture. But the message is current earnings actually look pretty decent. Like they haven't really seen too many falls. But the question for the macro outlook is pretty bad, whereas the micro outlook is still pretty good. And the question is that just because the economy is way stronger than macro forecasters are expecting, and that this underlying strength will carry you through, or is it that actually things have changed now, and it just hasn't hit the micro side yet? And so and as it does, companies will then start downgrading forecasts, and we're more in that second camp than we are the first. But obviously watching what's happening at micro levels as well. And actually a good example of that as well is that what's been happening in some of the supply chains. So in particular in the US, what you're seeing is that the one end of the supply chain, which is the very local end, has been slowing rapidly. The other end, which is new containers going on it from China, has actually been falling rapidly as well. And the stuff in the middle has all been not too bad. And the question for that is saying, well, actually what it seems to be is that's showing is, yes, the inventories are full at stores and sales are slowed down a little bit. And so companies are no longer sending stuff from their warehouse into the stores anymore. And at the same time, they've gone and cancelled orders from China and sliced orders. And so you're seeing at both ends that effect. What's happened in the middle is these are the orders which you ordered, 3 weeks ago or 6 weeks ago or 2 months ago that still haven't arrived. And so there's still a fair bit of activity sort of happening in that part. And so, I guess it's that part where different elements of the supply chain can give you, different reads to what the overall supply chain is doing. Then so that's basically the wrap of where we're seeing what we're seeing in terms of markets. So very weak on the price. Earnings still looking all right, and so some record falls. And so the question is this now the chance to we've got the bear market, we've got 20% down. Is this now the chance to jump in and buy the dip, or are there other things going on that are worth sort of stepping back? and I'll steal our some of the final part, which is, we think for bonds, the answer is yes. It is now time to start getting into some of these trades, and the answer for equities is probably not yet. That there's absent a quite remarkable turnaround in the second half of the year. It does look like earnings are probably going to weaken sort of further on. But let's go through the big parts. So, I guess, Dave, do you want to talk fiscal and monetary globally?
Sure. The main driver of the slowdown, obviously, is coming out of all the COVID stimulus and central banks tightening, chasing inflation, and just fiscal stimulus rolling off naturally as it's no longer needed. And they've turned into a couple of pretty epic headwinds. Now, there's a really good way of tracking the sort of aggregate impact of those, and that's financial conditions indices published by various people. We've got an example of the Goldman Sachs one here, and you can see on this chart that excuse me, this is for the US. That really it's only about halfway back to the kind of peaks that you expect to see in a tightening cycle. And with inflation the strongest it's been since the 1970s, the likelihood is that tightening cycle will persist for the time being pretty aggressively. And so you can expect this FCI, as it's called, to continue rising, probably to the same sort of levels, at least, that we saw during the initial era of COVID shock, perhaps even up around. Sorry, Damien. Yeah.
I was just going to say as well, and as well with the US, this is a US index. I should have put some of the other ones in there as well, because this is actually one of the. Well,
this is the easier one. Yeah, the US is much looser than anywhere else still. Most of the global ones are much higher than this already. So, it's a combination of interest rates, spreads, equity prices, all sorts of different things go into this thing, and fiscal. And so, at the moment, we're probably halfway there in terms of how much tighter things are going to get, and that's required the largest, swiftest sell-off in bonds in 200 years, and the biggest crash since 1932 over the start of a year. That last bit obviously being very important in terms of context. It's not the largest crash by any means. So, in short, things are not tight enough to snuff out the inflation yet, and so the Federal Reserve in particular will continue to tighten. The implications for that are all pretty straightforward. We've already got the stock market beginning to price in the distinct possibility of a recession. We might just flip over and start with the US economy here, Damo. If we just scroll down
sure.
a few, we can see the impacts basically.
Slide 13,
slide 13 that the Fed's already had, and fiscal tightening, and it's pretty dramatic. We've got the Conference Board leading indicators chart up here, and it's slid from extraordinarily robust to very negative very quickly, and is very likely to continue to slide. So it's already below where we were in 2015 and 18 when the Fed bailed out of its tightening programs for fear of a market crash triggering a recession. But now it doesn't have the luxury of doing that, because in those eras or periods it had no inflation to contend with, whereas now it has remember 8 to 9% currently in the US, and it's not even peaked yet.
And very low unemployment as well. So
yes,
from an employment perspective, they've got room to.
They do. They have room to tighten and stuff. Yeah. So the US. I think the US economy is almost in recession now. There's a lot of people talking about 2023. I think they're way behind the curve. If it's not in recession now, it certainly will be. Well, I think the base case is that it will be by Q3, at the latest Q4. but I would expect it to be pretty soon. It's this toxic combination of all this removal of liquidity, falling asset prices. Now we're starting to see hiccups in consumption, as the wealth effect kicks in at the household level. We're also seeing the shift from the big goods boom back to services, and then we've got this huge inventory accumulation in the US that is very likely going to be run down, and so those are very, very classic recessionary circumstances. So we think it's a pretty clear base case that it's underway and going to get worse. So the important thing to remember then is once the US consumer, kind of gives up the ghost a little, then the immediate impact of that we've seen over time and time again, of course, is that the US consumer is the global number one driver of demand for emerging markets and also for Europe, because all of these other economies, really structure themselves towards export markets. So if we head to slide 10, and we can have a look at the European economy first. So as the US is sliding away from this extraordinary boom and going to have a contraction and, pause all of that inventory building, then you're going to see the what was all called the bullwhip effect in global supply chains, which was just, as we've modeled for everybody over the last 12 months, it's just that the further down the supply chain you get, more exaggerated the shock becomes when a retailer, for instance, stops ordering perhaps 10% of its regular flow of goods. Then that gets amplified the further down you go into production. So you get this reverse bullwhip effect where falling inventories in the US will just spill out into the world as an export shock to everyone else. Now, the problem with this is everyone else is already weak, as we've been describing for months. And the first place that is weak is Europe. We've got a couple of charts here on, why. I think we're all aware of why, and that is, it's going through this extraordinary energy shock, which has caused quite a lot of demand destruction to energy-intensive industry, and a big consumer shock as well. So a lot of sentiment indexes, both for business and consumption in Europe, are very low, and it's the economy there is sort of just barely stumbling along at stall speed.
And so for anyone just listening in, so the two charts we've got up is one's the ZEW Economic Sentiment Index, which is basically back to similar levels it saw in the financial crisis. And it's actually lower than it ever saw in the sort of 2000s, and back to roughly similar levels to where we were when the pandemic hit.
Yeah.
And then in the other one we've got up is the energy prices. And in terms of energy prices, it's a wholesale energy prices in Europe. And this is a chart from the Eurostat. It's a chart from one of the regulatory authorities in Europe, sort of forecasting where they're expecting prices to go. And it's sort of showing that $50 a megawatt hour was where you were for wholesale electricity prices for 2018 through to 2021. And then you've had Putin starting to slow down in terms of the oil price, in terms of what it was doing with gas, with the whole. And then once it invaded the Ukraine, then the whole thing went even more haywire. And now you're talking about somewhere between 4 and 5 times higher for wholesale electricity prices, and Europe's not expecting that to come down. So they know they've got to make the transition. They're going to sort of get as much LNG on as they can. They're going to get as much renewables on as they can. They're going to put some more coal back in. They'll, maybe some more nuclear. But the net effect is none of it's a quick fix, and nobody's expecting this to go out quickly. So energy prices are likely to stay high for some time. Is what they're looking at.
Yes, although I don't think they'll be factoring in a global recession into that chart. But that said, this would be largely coal and gas, thermal coal and gas in that chart. So They probably will be a lot more sticky than they would normally be in a global recession, and that's a big warning for Australia and Australian policymakers in particular, that if they're expecting our local energy shock to dissipate anytime soon, then they need to look at this chart, which goes out for years, and how long they want to allow war profiteering to blow up our own energy markets.
Yeah, and the thing as well is, I think that Europe know they want to get away from Russian gas, and so if prices fall, then it's likely, if prices halved overnight, it's actually likely that they would then accelerate some of their plans and just and prices go back to where they were. So if you know what I mean, like, so
yes,
yeah,
they'll cut more out. Yeah.
They cut more from what they're using in Russia, and that sort of keeps prices to a level,
Yeah.
to roughly a level where they're
Absolutely. So in short, Europe is in no position to take on an external shock. In fact, it's already in one, which is what you would describe the energy shock as. So if it was to get a trade shock coming out of the US, then it's gonna fall over. So the other big economy that we're looking at in those terms, of course, is China, and this would be even more the case with the Chinese economy, which is even more exposed to the US consumer, and it's in an even worse state than Europe. Now it's probably growing again after being in recession for the last couple of months, owing to its zero COVID policy and the Omicron outbreak. Omicron continues to present itself around the country, and some of the more infectious strains aren't even there yet, I believe, so it's only going to get more difficult. So they're in this kind of state of rolling lockdown, which we think will be a state of semi-paralysis for economic activity, more particularly in services, because where there's people-to-people contact, there's obviously going to be caution and regulation, considerably more than usual. But it has been coming out of that because the recession that we saw over the last couple of months, or the contraction, depending on how you define it, was driven by a couple of big city lockdowns. So Shenzhen initially, and then Shanghai afterwards, and they've been kind of cleared of a lot of the virus, and so are reopening, and so activity is starting to roll again. All the mobility is coming back, etc., etc. But we just don't think it's going to get terribly far before it has to continue to kind of stomp on these outbreaks, and that'll hold it back. And the second component, of course, to China's sluggish domestic demand is the extraordinary property shock, which we'll just flip over to the next chart.
Actually, before you go there, I just want to talk. So the idea with the Omicron is that, they've been successful, but they've got to keep being successful. So that's that rolling lockdowns until the end of the year. The one thing that could flip that around is there's rumors that the World Health Organization is being pressured to reclassify the severity of COVID. And if that came, then there could be room for China to. Then it gives China, the cover to change their view, and to sort of say and open it up and just sort of go, okay, now this is endemic. They can stop reporting deaths and all that type of stuff, and just sort of roll with it, pretty much the way the rest of the world is. Well, I think the rest of the world is still reporting, but it's I guess ignoring that. Ignoring it. So there's that, and the second part is there's a chart. There's a table just up on the right there, just sort of showing, before David does get into the property sector, whatever it is, 8 or 10 things that coming, once a week, once every few weeks. There's announcements coming out of the things that are various things that China's doing to ease. I guess I just wanted to highlight that X, these 3 red lines that Dave was talking about. All these announcements we've heard to date have really just been very minor. Sort of, I've changed where this deck chair is facing, and this one I've painted a different color, and all that type of stuff like that. They're quite minor changes to the overall Chinese market. It's those 3 red lines that are the key that would actually show you that China's going. If they drop those or create ways for companies to get around it, that's where the property market's back on. The fact that they've lowered their LPR by 5 basis points in January, and then again in May by 15 basis points is not going to turn the housing market around. It's these are just sort of all very, very minor things that they're doing to try and keep things ticking along.
That said, it has improved a little in the last few weeks. I did have a chart on that, but it's gone. But yes, but I think what we're seeing in the last couple of weeks is just reopening, and so a little bit of pent-up demand and things. Plus, there was some distortions in dates and holidays and things. But yes, the likelihood is that those things will have an impact at the margin, but they're not going to get sales up anywhere near where they used to be, which is, and probably the greatest likelihood here is that this is just a structural adjustment, and the sales never go back to where they used to be, where they were in the last few years. But the implications for their immediate discussion is, that owing to Omicron and the parlous state of Chinese property, which is down 40% year on year, sales volumes are for new property, and that's like a quarter of the economy when you put in all of the various spillovers. Then Chinese domestic demand sucks right now, even though it's rebounding out of its lockdowns. It's not going to rebound very far. Now, they are stimulating. They're throwing a lot of money at infrastructure and stuff, but given these two headwinds, it's just not enough. We think that domestic demand is going to be quite weak, and it's going to miss its growth targets by a wide margin at the rate we're going. And that's before we get to the next shoe to drop, which is what we've been discussing, and that is a spillover trade shock from the US as the Fed breaks something in America. So that gives you the basic top-down kind of narrative that we're working with, and is why, despite, as we described, the bottom-up picture, earnings are still really rosy. It's why markets are really taking it on the chin, because everyone's starting to kind of cotton on to how difficult this top-down story is, and the market always moves in advance of the actual numbers. That's what its whole role is, to discount the future. So, basically, what we've been talking about for the last kind of 6 to 12 months, I guess, is starting to come to bear.
Before we go on, Dave, there's a bunch of questions out there, Sam, that might be worth.
Yeah. Yep. So we've got a question from Cam Crick, and he's asking, why is the ASX held up better than the US, and will we go down as far if the US goes into recession?
So I think there are two reasons why. The first being because of it, we buggered up the vaccine rollout and then the RATs rollout as well. The Aussie business cycle was kind of delayed for a quarter or two, and so we've been lagging the US in terms of the post-COVID recovery, and so we've had growth accelerating out of that as it's been decelerating elsewhere. So we appeared to be immune. So that's the first point. The second one is Ukraine energy shock. If you just look at it in very simple terms, it can be seen as a bullish kind of outcome for Australia. Our terms of trade hit levels I didn't think were even possible for a few weeks, as everything went nuts through the roof, in particular the two coals, but also gas. And iron ore rallied as well, and all the base metals and all the ags. So, I mean, in the sense that the Ukraine was a demand destruction shock for energy importers. Australia's an energy exporter, at least in simple terms, and so we were suddenly a bid into that difficult environment that was really hitting other places, including the US, where it was more of an inflation issue. So I'd say those are the main two reasons. Damo, you want to add anything to that?
Yeah, and that sort of leads to the second half of it, which is the Australian economy is largely a commodities driven and housing driven market, and so both those sort of had their positives in the first part. The houses obviously have turned and started becoming negative now, and with interest rates rising quite rapidly here, and a lot of the fixed mortgages rolling off later on this year, that will very likely reverse. And as the commodity prices, at least stop rising, and quite possibly, see some falls amongst things like iron ore and copper and other sort of the metals, which are less the energy ones that are, sorry, not the energy ones, but the ones sort of more exposed to the Chinese housing cycle. We would expect the Australian market will catch up on the way down to the rest of the world.
Yes, I agree with that, and I'll go further. I actually think Australia's probably going to have a worse recession than a lot of other developed markets once the RBA's overcooked it. Because, as Damo says, we're more vulnerable to house price falls given household debt, and in particular the variable or floating nature of all the mortgages. The sensitivity in that regime is much higher than some other countries. And secondly, can't let this one go without mentioning the self-imposed energy crisis, where for the last 20 odd years or so, Australia's run a very simple economy. It doesn't involve itself particularly in modern economics. It's both pre-modern in that it digs up stuff or grows stuff, and postmodern in that it uses financial engineering. And what I mean by that is we sell our commodities to the world, and then we take that income and we use a whole lot of financial engineering to go and leverage it in global markets, or our banks do, and then they tip that money into the housing market at home, and that drives wealth effects and demand for services. And that's been the basic mechanism of the Aussie economy since the late 90s and the rise of China. And that's become more and more entrenched, and we've become less and less diversified as that's transpired. But what we've done now with our energy shock is, owing to the fact that international cartels for coal and gas are now charging international prices for our locally mined materials, we're now
at least on the East Coast.
On the East Coast, yes, which is obviously the largest part, at least, of the services economy. So we're now paying the world income to mine our commodities in some large measure, which means we no longer have that income to leverage up, and so we're being charged more for the debt that we borrow to put into houses. So it's like the whole model has inverted, and I'll just finish by saying the Labor Party is insane if it doesn't curtail the energy cartels, because it's going to lead to a much more severe recession here than elsewhere if it doesn't, because inflation will be sticky, the RBA will be driven up too high. So that's a long-winded answer. We expect Australia to catch down both in terms of equities and growth.
And that flows into Chris's question there, Sam. Chris.
Yeah, so Chris is asking, how do you think the Aussie dollar, US dollar will fare if we continue to have inflationary pressures? So yeah, what are you guys, your take on that?
Well, I'm still pretty bearish on the Aussie dollar. As long as the Fed's still hiking and the US economy is crashing into recession, then the US dollar is going to be the only game in town in Forex terms. And don't forget as well, so far all of this is kind of narrative driven, discounting the future. And what usually happens in these circumstances is that the Fed actually breaks something, a credit market in a country or at home, or at the moment it's just equities, but it usually spreads into some other market, like somewhere. In terms of it being a critical, it turns it from being an interest rate narrative to a critical liquidity and solvency crisis for some market, and then everything just poos its pants at that point.
Yeah.
And so we haven't got there yet. Like, it may not even happen. I don't know, but there are a lot of candidates for it to happen, including, I would argue, a China capital flight crisis is a possibility. But while that is,
Dave, just so that you can, just for people to understand what Dave's talking about is say the financial crisis that happened. The Fed was raising rates and the RBA and everyone raising rates into this very strong economy until all of a sudden these mortgage funds were like, actually at those rates, this game doesn't work anymore, and we can't get enough people to borrow, and we run out of that. And then as those started to fall over, then all of a sudden everyone went, wow, look at all that dodgy lending that's been going, and everyone takes this massive step back and says, I'm not going to lend anymore, which then sucks all the air out of the economy, and next thing you know, you're into a bigger downturn. And there's similar ones in prior downturns. 2000s wasn't quite the same because it was that whole tech boom, but you go back to the one before that, which was largely a corporate driven one, and the same effect. The money comes out, all of a sudden the corporates don't have the borrowing that they can do, and you get that big fall again. So it's that idea that someone will go bust somewhere, and then all of a sudden everyone will be like, just a minute, I've been lending to that sector.
Yeah, I mean, in 2001 it did happen. Like, you had this wild NASDAQ bust, and you had companies like Enron and WorldCom, and these huge telecommunications companies just going under. And it may just be something similar to that. It may just be equities. I don't know. But the point, to answer the question, so long as that remains the clear risk as the Fed tightens, and it's still got no choice as it attacks inflation, then the US dollar will remain bid, and the Australian dollar will be on the nose, because the Australian dollar likes risk appetite, and that circumstance is the complete opposite. So I think until we get to the point where the Fed pivots, and possibly B, the point where US growth bottoms, it may go that long, not just when the Fed pivots, but because the Fed may be forced to pivot during one of these crises, and that may actually not be enough if the crisis feeds on itself, not initially enough to stop the bid into the US dollar. But that's about when you'd want to be getting out of US dollars and into Australian dollars, because once the US growth starts to rebound and the Fed's pivoted, then you get a whole raft of reflationary forces that flood capital back out of the US and into the world, and that's the circumstances where the Aussie just flies. So for the time being, still a bearish story.
And then the question on Japan sort of fits in as well. That's one area we have ignored, Sam.
Yeah, so question from Joe. He's just asking, are you guys concerned with Japan, considering the yen's been tanking lately?
Watching it, definitely. I mean, one of the things that could possibly break, as we've been describing, as central banks tighten everywhere except Japan. Japan's like the last printing central bank standing, because its inflation is still very low, and has been for so long that it's protecting, an easy money regime that it thinks is still necessary. But because everyone else is hiking rates, the yen's just falling through the floor. But that's kind of going to make them happy. They largely run an export economy. They're pretty used to markets flipping out over their money printing and QE from time to time. Is it possible that markets could break the BOJ, the Bank of Japan, and force them to stop printing money? Yes, probably is. But would it happen in a time frame before the rest of the world falls apart is probably the critical question for me. And I think it's probably not going to have enough time. Like, I think given the sort of rapidly accelerating risk off around Fed tightening, and we're starting to see the US economy fray, I think it's all happening quicker than anybody expected, then you'll actually, once this recession narrative starts to really take hold, then people will just stop worrying about the BOJ printing, and money will be repatriated there. very, very strongly. When you get these intense market seizures and risk-off accidents in global markets, then the yen is sorry.
Everyone will be printing at that stage.
Yeah. Well, yes, and everyone wants yen at that stage. It becomes a safe haven currency because there's so much Japanese capital that's flooded around the world, and a lot of it gets repatriated, and the yen always flies in those circumstances. So I suspect that we won't see the BOJ broken, but if we did, if like the inflation problem got strong enough in Japan before the global recession took hold, then you would see another leg higher, probably globally in bond yields. It'd be another shock to capitulate those holding bonds, because it would be the last QE bank standing collapsing, and that would send the inflationistas wild for a few days, and not for very long. I would hazard, in fact, if it did happen, I'd be in there buying those bonds with both hands, because it would be a kind of, I think, brief bond backup and then immediate collapse towards when everyone freaked out about the level of rates and the impending recession. So I don't think that that's likely, but we've definitely got it on our watch list as possible things that could break to really upset markets.
Awesome. Thanks, Dave. So we've had a few other comments coming through. Joe RLT, he's saying that the S&P, it's still up about 30% over the last 30 months. So, in the light of that, market's still looking strong. And so this is just the last call for any questions, any viewer questions. So now we'll go into the question of the week. So this is for viewers to have some discussion in the comment section over the coming days. Question for this week is, does this bear market have more to fall? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And before we go into the investment implications, Damien, we've obviously released this new direct indexing product. So we've touched on it a couple of times, but would you like to just explain to some of the viewers what direct indexing is?
Yeah, sure. It's, from my perspective, I think of it as the next iteration of exchange traded funds, which sort of allows exchange traded funds are great, nice and cheap. You get to buy a basket of stocks very easily, but the problem is you get everything. There's no sort of nuance to it or anything like that. You basically, whatever the market's got, you've got. And whereas the direct indexing actually lets you take some tilts yourself as to into sectors you like or away from sectors you don't like, for either investment reasons or for personal ESG type reasons. And we've sort of introduced it as part of our suite, because we sort of have a mix of investors, some who like us to make a lot of the decisions for them, some who like us to make some of the decisions and make some of their own. And it's sort of, for us, it's part of that whole transparency part and managing to keep all these assets into letting people invest with this idea that we might have this core part of people's portfolios, or the nucleus, that they want the sort of safe, secure Aussie government bonds, large cap shares that sort of sits there with the lower risk part, and then around that sort of there's then investors can do what they like as to whether they want to have stocks or bonds or higher risk hedge funds and things like that, and I guess what in our view this lets them one more tool to sort of create the types of investments that suit them.
Thanks for that, Damo. And if you want some more information about that, just go to our website, nucleuswealth.com/direct indexing. And if you want to have a discussion with me, you can book a call through nucleuswealth.com/contact. I'm more than happy to explain it in a bit more detail and show you how you can take advantage of that. We can run a few different scenarios with we've got a Australian Leaders Fund, and some international funds. Feel free to book a call. So now we'll move into the investment implications.
Dave, do you want to?
Sure. So obviously we think the base case is a global recession, and probably quite a nasty one, given those kind of toxic self-reinforcing dynamics. With the Fed having the biggest inflation problem on the planet and having to tighten past the point where it normally would at this point in the business cycle, that is tightening into a recession, even as it happens, because it has to do what it can to squash inflation. And that's spilling over then to already weak China and Europe, and emerging markets just bring up the rear in that scenario. And they're all very weak already because they've been tightening for much longer than DMs. So we've seen the yield curve invert in the US twice in the last kind of 3 months. I would expect that to probably get worse. And the other, I guess, thing to note about this is we think it's happening much quicker than anyone thinks. And indeed, the US may already be in recession, but will very likely be in recession very soon. It's not a 2023 story. Stocks are very expensive.
Actually, sorry, Dave, can I jump in quickly on the bond side? One of the things we do think is that the bonds are the most likely to be leading this. So they shot up. Yes, we've had a bad quarter, but it's more likely the bonds fall first. Bond yields start to fall and bond prices recover before you see a recovery in stocks.
Yes, exactly.
So that's our preferred sort of asset at the moment.
Yes. Stocks, obviously, the valuations have come down a lot, but the problem is that if we get a good recession, then earnings need to be discounted probably by 25 to 30%, and we're nowhere near doing that. And so if your base case is recession, then stocks have to fall further. Inflation is low, the Fed put. I mean, that's just essentially what I was talking about before, but there is an important component to this, which is becoming very fresh in the last few days, and that is you can almost characterize this battle as the Fed versus oil now, I think. I know there is other components to inflation, but it's energy and food that have really taken off post-Ukraine, and oil is like the poster child for that. And so the Fed needs to break oil, I think, before it can pivot away from tightening. And we've actually seen for the first time this year, in the last few days, oil starting to really hiccup. The oil price is down, kind of $10. And even on the days where money was still flowing into stocks and there was a little bit more risk appetite, oil was still falling. And leading that, the industrial metals are all getting belted. The copper especially has now broken critical support. Iron ore has been hung out to dry. So we're seeing the entire commodities complex capitulate slowly but surely. And oil will be the last and biggest of that. And that is actually, I think, the beginning of the end for the Fed tightening cycle, but it will take time. I think it needs to push oil considerably lower. Perhaps not as low as we used to go on these things, such as 2015 and 18, but in fact, definitely not that low. It's not going to want to snuff out US shale, so maybe $60, something like that. Maybe anything below 80 would start to satisfy the Fed that inflation is starting to get a handle on inflation. But until then, yes, absolutely DXY bull market and Australian dollar continuing to fall. And we think there's more downside in stocks. So I guess in answering the question that we posed to begin this thing, there are more teeth in the bear market, I think, is the base case. There are risk cases where we might get a soft landing in the US. I think that's quite a low probability outcome, but you can't discount it completely because it's just moving too fast and too hard, and inflation's too high, and the Fed can't stop. And the obviously then on top of that is the risk case we've kind of discussed through this podcast of where the Fed actually breaks something quite important, some market somewhere or some set of bonds or a country anyway, someone larger than Sri Lanka, and we get into a really serious kind of capitulation event in all markets, which would then of course flip the Fed back to QE, and that'd be obviously the point to be buying risk assets.
Yeah, and when David says, for anyone who's not watching, Sri Lanka's having a debt crisis at the moment. And I guess the question is, I suppose it either needs to be a bigger country, as you said, David, or a range of countries, I guess, that could do the same thing. So if you had sort of broad spread across whatever it is, half a dozen or a dozen emerging markets running into the same problems, then you could, that sort of the type of dominoes falling that would constitute that same crisis of where the Fed breaks something, as you said.
Yeah, I mean, the obvious candidates are emerging markets. I'm not sure we're going to have time to get into the really big one. I mean, the one that I've worried about for the last 6 months or so is actually an external crisis for China. Like, I think that one's plausible still, and by that I just mean, capital really just floods out of China because it's got a chronic growth problem. Its monetary and fiscal policy can't force it to grow anymore because it's for various settings, the credit's not getting through to the real economy. Capital starts to flood out, their interest rates start to rise, and you're into a classic kind of emerging market external debt crisis or external crisis, with the yuan falling heavily. And if that were the case, then markets would really be shredded. And I'm not saying that is probably not a base case, but again, that's kind of on our watch list of a possible exacerbation of things.
Excellent. We've just had another couple of questions come through. So one from Chris G. He's just curious to know your thoughts, whether there's a peak in the yields on the US Treasuries, the 10-year and the 30-year.
Well, I can't be certain. It's certainly looking peakish. Yes, I mean,
I think probably
like the yield curve there is getting absolutely steamrolled on the looming recessionary problems. There may be a Japanese shock or something to give it a leg higher, but I mean, it certainly looks like yields are high enough to have caused problems, the housing market's stalling, etc. I don't think the Fed will keep raising for the short end, but I think that curve just keeps flattening and going and inverting.
And I think from our perspective, it's at high enough levels that if you're taking a bet now on a medium-term basis, that over the next 6 months to a year, we think that the yields will be lower, but if it's the next, it could be coming. Could have already peaked and it's down, but as Dave said, that things can happen in the short term to push it higher. I think there's the odds are with you that they're at levels where if they go much higher, they'll be coming back to where they are now. Is our view.
Yeah, I mean, I guess the point is they're already at a level the economy can't handle. So if they go higher, it won't be for long.
Okay, and we've had another question from Cam. He's asking what sort of inflation would the Fed tolerate to go back to lower interest rates if there was a recession?
So well, they want to see a path back to their 2%. It doesn't have to be immediate, but
and inflation's lagging as well usually.
Yeah.
So if they saw, I figure if they saw falling interest rates by 1% per month or something like that, David, and if you went 8, 7, 6, 5, and the bottom is falling out, they might be prepared to cut at 5.
Yeah, I guess the thing is, I think the more important question is because they're having to overshoot rates higher, they're probably going to undershoot inflation in the next 6 to 12 months. Like, they will bust something, they'll break something, markets will melt down, asset prices will go lower, and everything we've talked about today. And I think that my base case for next year in the US is probably deflation, like negative inflation. We've described any number of times. Our favourite analogy for this is the post-Spanish flu in 1918-19. and the post-World War I period, which had a remarkable similarity to where we are now with deglobalization and supply chain issues coming out of a pandemic. And they got inflation shocks. The Fed raised rates exactly the same way, and they went from 15% inflation in 2019 to minus 12 in 2020, in 1919 to minus 12 in 1920. So that's obviously exaggerated, but I would not be at all surprised if US inflation is negative by, if not this time next year, the second half of 2023.
Excellent. Okay, thank you very much. So that almost wraps us up. So Damien, Dave, just want to thank you guys as always for sharing your valuable views and opinions, and we look forward to the next episode.
Thanks, Sam.
Thanks, guys.
So we do welcome your feedback on this podcast, especially in regards to future topics. So if you do have any ideas, please drop it in the comments section below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your financial personal situation, please go to our website at nucleuswealth.com and book a call with myself or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. And if you'd like to see more of our previous episodes or content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all major social media. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.